So now we will look into economic indicators, and to understand economy you need certain factors, right? How would you judge economy? So how do you judge a student? You judge him by how much marks he has scored, so how good he is at academic, right? Then how good he at sport, other extracurricular activities, right? So these are the different attributes on which you go and judge a students. So similarly, there are different economic indicators on which you judge economy. And as we have seen, economy and stock market are highly correlated. For shorter duration, for shorter period, they may not move in the same direction, but later or sooner they will come and walk together. This is what we learned till now. And this video we will focus, this part of the class we will focus on economic indicators. And when I talk about economic indicators, as we studied, microeconomics and macroeconomics are two parts of economics. Economic indicators are mostly on the macro side. Major indicators belong from macro part, and we are going to learn also only on the macroeconomic indicators, because if you know the top 4 economic indicators, you will have enough understanding about how to track the stock market and understand the repercussion of these economic indicators on a stock market. But something which I want to warn you here is this, that just because now you know about indicators, this doesn't mean that you will make money based only on indicators. Yes, you will look at indicator and you will have certain information. If you are more aware about indicators, you will take right decision. But this doesn't mean again that you start timing the market just because you know economic indicators, and market depend a lot on economic indicators. And I have a reason behind this, which I'm going to explain you also. So you know about bull market and bear market. So bull market is something when market is expecting a growth, positive outcomes, and increase in Nifty and Sensex for a good time, good period, right? Bear market is something when you see that, okay, market is not going to do well, probably not doing well right now also. People will not make major returns in stock market in bear phase. Well, so where does this bull market and bear market come? Well, this bull market comes just because your economy is doing well. Bear market is coming or going to come because your economy is not going to do well, right? But then this economy is made up of both organized and unorganized sector, right? So a new term I have given you, organized sector and unorganized sector. To give you a difference, so a lot of vegetable sellers are there. They are having small shops, non-registered shops, and they are selling vegetables, which is important, part of your life. Food is important part of your life, consumption, and vegetable sellers are giving you vegetables. Now what happens that they are not in form of a company. They are not very organized. It is little difficult, to identify exactly that how many vegetable vendors are there and today how much sales they have done. So you will say that they belong from the unorganized sector. And people or the companies like Hindustan Unilever Limited, ITC, they also make fast moving consumer goods, but you can track their sales, how much sales they have done last year, how much sales they have done this year. So they are from the organized sector. Now stock market track the organized sector, right? A stock market outcome, which is like Nifty is going up or down, is based purely in the organized sector businesses. Now what happens here that your indicators tell you combinedly for organized and unorganized sector both, right? Now what happens that people who are there in stock market, who are expert, tomorrow you will also become expert, and then you will come to know this, that companies start showing that sign that better times are coming based on the orders they receive, right? So what happens that the biggest lead indicator of growth of economy is basically market. So I would rather say this, that instead of market economy leading the market, sometime or majority of the time it's market which starts showing a sign that there is a growth coming, because they are organized. They have numbers, they have numbers to predict. So a lot of people who go and track these companies' sales, profit, expected sales, booking, advance booking, lot many factors are there through which they can get a sign. So yes, they go together. A good indicator, economic indicator will be a sign of a bull market, a growth phase market, but it can be vice versa as well. And the vice versa is like growth lead indicator is basically market, stock market. So you have to understand here that the mistake which you do not have to do is like this. So you saw that, okay, there is a very good number came for one of the important economic indicator. Now you will assume, okay, this number is really good, so I should go and invest into the market so that I'll make higher return. Well, you may get disappointed, because market would have already perceived this much in advance, that growth phase is coming and good numbers are expected, and people have already bought at lower levels in the market and rather now just waiting for these numbers to come out. This especially happens with smart money. So people, big investment banks, they have highly paid economists, and they are able to forecast these things, which you won't be able to do as a retail investor. So what I'm trying to warn here you is, knowing subject is one thing, and using that subject very intelligently is a different thing. That's why when people say that, Kundan, can I make money out of your course? Then I say no. But what you can certainly do is you will not lose money in the stock market. The reason why I'm making this course is not because I want people to double their money every year. This is very unnatural. What exactly I want is people don't lose money in the market. And they understand all these things, So yes, good indicator is required for the economy. Performance on the economic indicator on the positive side will be always better for the economy, but that should not be the sole decision making point when it comes to investing into the stock market. Well, this was a philosophy part. Hope you will keep this in your mind. Now we will move and cover one important economic indicator which I thought I'll place at number 1 position. We will cover that in this video, and in the later videos other economic indicators. So here we are going to cover CPI. Full form is Consumer Price Index, right? So as the name suggests, consumer. Who is consumer? You are a consumer, I am a consumer. What do we consume? We consume food, cloth, give rental, lifestyle products. We go and watch movie, entertainment, healthcare, education, convents, and every other things which we consume, right? So this CPI track that how much we spend on an average for our household budget. Isn't it beautiful that we are doing a stock market class and now we are discussing about our household budget? This is what I told you. Everything is very much related. Stock market, economy, they all drive. You all can drive conclusion out of your own household stuff, and how that you are going to see now, So CPI is Consumer Price Index, which is calculated based on how much on an average you spend. So let's try to understand how does it get calculated. So what happens that it is a responsibility of the government that, since people are going to earn limited, it's not like they are getting paid 10 lakh rupee salary this year and they will be paid 20 lakh rupee salary next year, all of them. No. For people, the basic needs are required, and government responsibility is to make sure that those things which we consume, those basic needs, is within the reach for every common man. So they keep on doing survey. and they publish it in the form of a report where they show the increase in percentage. So what exactly happens is, as you have understood about Nifty and Sensex, let me just show you. So what do you see in Nifty and Sensex? You see that Nifty is also one index, correct? And this index is based on the weighted increase and decrease, cumulative weightage increase in these companies' stock. So similarly, here in all these things, government decide that they will give certain weightage for food, cloth, rental, and other economic, other household stuff which is required, other consumption. So they may give, they say that, okay, food is something which is very important for everyone. So maybe food may get higher weightage. Higher weightage means it can alone take a weightage of 35%. So food is something which inflation should be in control. This is what the government will try to. So what they do, that they give a weightage, and on that weightage they finally calculate that how much in total the budget of a common family has increased, and that increment has to be measured in terms of percentage. Different family may have different need. Their monthly budget will be something else, right? Some people will have highest of their consumption only into probably food and cloth. They are not going for entertainment, healthcare, or education. The poorest of the poor. Some people may have, very good lifestyle, and they are spending a lot of money on the lifestyle, but government is not bothered about that, whether you are wearing a shoe worth 20,000 rupees or not. Government is more bothered about whether everybody is having bread or not. So they will probably give bread the more weightage than lifestyle, right guys? All right. So here, this is how it get calculated, that they give a weightage to every consumption, and then they see that that specific consumption has increased by how much, and then as per the weightage, they calculate and show it in the percentage form, that what exactly is CPI, how much CPI basically has increased, right? So they take a time frame. They don't consider it month to month, okay? Like previous month, so this month is December, last month was November. They will not see the increase from December to November, that from how much percentage it has increased. They rather see it like what was the total. So let's take an example of one common man family. So let's say this family total expense on all those consumption was 40,000 rupees in December 2018. Now in December 2019, they calculated that they had to spend 42,000 rupees to avail the same consumption. So how much the total budget has increased? 5%. So from December 2018 to December 2019, the total budget has increased at 5% in common language, and this is what is actually the increase in CPI index, Consumer Price Index. Hope by now you understand that what exactly is CPI index and how it get calculated. So from previous year to this year, in complete 1 year, how much the total household expenses has increased by percentage is something, a number which will always get reported by government and the agencies, as agencies sometimes forecast, private agencies also, that how much they are expecting as the index, right? So the another question now here is that, okay, we understand that inflation is there, the CPI is that index which is basically tracking the inflation. This is called inflation, right? Something was 100 rupees, now we are buying at 105 rupees. So it got inflated. This is called the inflation also. So in a way, they are tracking the inflation at the family level, right? Now, the point here is what information we have to draw out of it, right? So how does market look at it? Now, in 2018 probably, or 2004, so some in recent years only, government and RBI, they are, they work hand in hand, and they agreed upon something called inflation targeting mechanism, where they said that that inflation, the CPI increment has to be there in a range so that we can predict things and accordingly run the economy, right? They got the responsibility, and it is possible to control also. So they have, the authority have this responsibility to do, but they can control it also. That is also they know, and how exactly I'll going to discuss here. So 4% is something which in India, RBI and government has decided that 4% inflation is fine. Increment in CPI index of 4% is okay. And anything like -2 +2 is also okay. But anything above 6%, like, last year you spent 40,000 rupees on your household budget, and this year if you have to spend 50,000 rupees on the same thing, then it is really a dangerous thing. I mean, the percentage comes to 12%. So up to 6 or up to 2 is okay. Now you can say that if lower is fine, why below 2 is bad? You can also say that. People can also say that. So let me tell you something. Market always try to give a range of CPI percentage increment the maximum respect. If it fall below even 2%, they take it negatively. How do they take negatively? They take it like, okay, companies who are producing goods are probably not able to increase the price. As the consumer demand has gone low, people don't have money, the purchasing power, and that's why probably they are not even buying. And if they are not able to buy, companies are not able to increase the price, and that's why the inflation is low. So even very low inflation is also not considered good. And anything like hyperinflation, so CPI was reported 14% in 2012-2013. Rupee devaluated like anything that time. Our market also crashed, and that was not a good scenario to have. So anything like below 2% is also bad, and anything above 6% is also considered bad. Now you will say that how can government control it? So government have a mechanism. So with help, so so RBI, basically it's RBI. I should not call government as RBI. RBI is a independent functioning unit, but they work with finance ministry. So what happens that if RBI see that there is a inflation, very high inflation, they understand that one of the reasons behind this inflation is very high growth, and just because people are flooded with probably money, they are ready to pay any price for any kind of commodity. No, that is also not considered very healthy, because this is not natural. It will not last longer. So what they do that time they start increasing the rates. They start making money more dearer. You have to pay more interest rate, and these kind of things RBI can control. They can give that mandate to the banks. Basically, they have to increase their own base rate. These are some things which we will also cover in the later chapters. But something you have to understand here, that CPI is one number which you can track. You can understand its implication, and you can forecast something like, if inflation is very high, RBI can intervene and make debt little expensive. And if they see that inflation is really low, they may think of giving more relaxations to people who want to take debt into their business, so they can decrease the rate. And increment and decrement of the interest rate by RBI will directly impact the stock market, and it is something which we will also see as a lead indicator in the coming video. But here I want to conclude that first learn about CPI. CPI is what I explained to you in summary. It's like a family, a household overall budget on the basic needs they have. That has to be in control, and if that is in control within the range, it is considered as a good thing for the economy, and a good thing in economy will result into the better growth, and better growth will result into stock market giving more returns to its investor as well. Right. So CPI is something which we have understood. Let's move to the next indicator in the coming video. Thank you.